Hey everyone, it's August 25th, 2015. I decided to make this week's video early in the week simply because a lot has happened over the last 4 to 5 trading days, or since I last made the weekly video that I think merits recognition. And hopefully, this video format, which I'll try to keep it short and simple, will draw your attention to a few points of interest that most investors should have their eye on and drown possible outcomes in the near and far out future. I want to begin by talking about the SPDRs ETF, or the ETF that tracks the price performance of the S&P 500. The two aspects I want to cover this week are the following. First, I've highlighted the two different price advances, or notable price advances, since the generational low in 2009 was set. As you can see, each price advance amounted to a 99 to 105% rally from low to high. Within these price advances, there have been a total of 5 corrections, with a median correction of about 13%. The correction we're in today has amounted to or close to 15%. So certainly it fits the profile of previous corrections as far as the percentage move is concerned. The other point I want to bring your attention to is I've highlighted with these rectangles a previous instance other than what we are experiencing today, where the S&P consolidated for 8 weeks before giving way to lower prices. The only other time this has happened, or a similar price pattern came about, was in 2011, when the S&P consolidated or distributed at the top end of its trading range for 7 weeks before giving way to lower prices. It took an additional 7 to 9 weeks for price to set a meaningful bottom before contesting the former high, which eventually led to a new all-time high. So if you're someone that relies on market symmetry, perhaps this is a good way of, a good starting point to analyze markets. I should caution, and I've noted this before, that markets are not perfect in that they're not perfectly symmetric. Yes, you can use symmetry to make give you a better sense, as to what markets may or may not do in the near future. But because there's different market cycles are constantly changing over time, and not one price advance or price decline is the same in composition, you cannot just extrapolate or believe that a given pattern that emerged before is set to emerge again. It might happen, but for that to happen, you have to be in the same market cycle, and you have to have a similar or identical price composition as far as a price advance or price correction is concerned. I can tell you from the onset that the price decline we got in 2011, or the market cycle, I should say, we got in 2011, is a completely different cycle than the one we are in today. When I refer to market cycle, I'm not just referring to the cycle as it pertains to the S&P 500, but I'm talking other markets as well. So just bear that in mind. But with that said, there's enough evidence to suggest that there could be a possible repeat of what happened in 2011. If that's the case, then price should bottom, or should trade over the next 7 to 9 weeks at this lower range between 1820 and 2014 in the S&P. What to look for? Most people are using the October 2014 low at 1820 as the low to hold over the next few days and weeks for the S&P to have any shot of potentially recovering some of the recent losses. For my analysis indicates that 1910 to 1920 in the S&P 500 is the higher weekly and monthly low in the index. A weekly or monthly close below 1910 to 1920 in the S&P opens the possibility for a trade as low as 1660 to 1680 in the index. On a percentage basis, that would be similar to the percentage decline we got back in 2011 from high to low. Again, markets can be symmetric at times if they're in the same market cycle, and there's a fairly consistent composition within the price advance or correction we're assessing. But they don't always have to be symmetric. Again, markets are more geometric than arithmetic, in the sense that they price, or they discount future price through a geometric sequence, not an arithmetic sequence. Um, but so again, if the S&P were to break below 1910 and 1920 on a weekly and monthly basis, that puts pressure on bulls to essentially rally the index back above 2000 to really have any chance whatsoever of recontesting the highs by year end. At trade below 1910 and 1920, we'll see the bulls trade at a lower level, as low as 1820 in the S&P, and ultimately only a break below 1820 and 1780 in the S&P will confirm that move down to the 1660 to $1680 range. As of now, it's reasonable to expect the S&P to hold 1910 to 1920 by weekend and by the end of the month, and trade it within a wider range. In other words, trade within a 200-point range between now and the end of the year. I noted before how I did not expect, nor do that hasn't really changed, the S&P to make a new all-time high this year. However, um, we should see a new all-time high being set sometime in 2016. I'll leave that for another video, and but for now, all indicators point to the S&P possibly consolidating within a wider range between 1910 and 2133 from here until year end. Only a break below 1820 and 1780 will confirm that move down to 1660 to 1680. To the upside, I mean, in the event for some reason that the S&P breaks out to the upside before year end and takes everyone by surprise, then 2181 is the level you want, the initial level you want to target. A good way to assess markets is to track individual names, even though I don't like to put too much weight into any one individual name, simply because just markets are too dynamic to just focus on one single factor to really assess what markets may or may not do. But since Apple is such a heavily owned, heavily traded, and heavily watched name, most funds, believe it or not, right or wrong, they index their expectations to whatever Apple or whatever their expectations on Apple are. So paying attention or doing some sort of analysis, however basic it may be on Apple, should prove to be fruitful for those of you looking to, again, reassess market conditions. On Apple, I've drawn 3 Fibonacci retracements from their respective lows to highs, and I've also highlighted a potential head and shoulders formation forming on the weekly. The left shoulder and the head have already formed, and Apple could be in the early stages of establishing its right shoulder. To be clear, Apple does not need to necessarily trade up to $119 to $120 to match the height of the left shoulder to create a right shoulder. It could easily as well, trade up as high as $112 to $115, consolidate for a few weeks, and then possibly break below the neckline at $104.17. If Apple were to consolidate for the next few weeks between $100 and $115, or even as high as $119, and then proceeded to break below the neckline at $104.17, which coincides with this fib retracement, the 61.8 fib retracement from the current low to the current high, or from the 52-week low to the 52-week high. Apple has the potential to trade as low as $74 before there's any buying interest by institutions, private client money, hedge funds, you name it, whatsoever. The way I came up with this target is simply by measuring the height of the head and shoulders formation. Roughly, that's a $30 point or a 30-point move. So you subtract that from $40, 104 minus 30 gives you $74. Percentage-wise, of course, it would be a bigger percentage move, but what we're focused on in here, is the dollar amount. One thing I should note is that if for some reason the head and shoulders formation comes about and we get a break below the neckline at 104, you'll only get a true confirmation of this potential break lower or from the head and shoulders formation if Apple trades below this fib retracement, the 50% fib retracement, or trades below the midway point from the former low to the former high at $94.84. So in other words, $104 is the neckline to a head and shoulders formation. But to really get comfortable with a shorting Apple, right, in the event that the head and shoulders formation is realized, you would want it, the higher probability trade is to short Apple below 94 down to 74. That still yields you a $20 move. Again, I'm not insinuating it's going to happen, but it's a possibility. What what else could happen? The other possibility is that Apple consolidates between 100 and 120 for the next few weeks, and then breaks, sets a new higher low, right, or retests and confirms the current higher low to then proceed and make a new higher low on a weekly and daily basis, not on a monthly basis, as we're reviewing here, and potentially retest the former high at 133, and then eventually break new all-time highs. So the skinny of it is that Apple, as with the broad markets, are in a very critical position. You either get a, from current prices, a 30, 35 point move lower, or a potential 30 or 35 point move higher initially, um, from here on out. So there's a lot to be said, and there's a lot to be proven, for Apple in the broader markets. Lastly, as far as the U.S. dollar index, I've made it clear how, as long as the dollar index stays above 2382 or this 50% fib retracement, the long-term bullish trend remains to the upside. Yes, this bearish engulfing candlestick is, should be taken with some dose of caution, some degree of caution, but again, that is more, for the day-to-day trader who is looking to go long the dollar. Longer term, again, if you're looking months or even years out, the dollar is still in a bullish trend. Um, Lastly, I just want to give you a quick rundown of how some of the emerging market currencies, which are to blame for the most part, for the recent meltdown, not only in commodities but really just now in equities. Um, a currency like the Brazilian real has declined year to date over 30% and over 50% in the last 2 years. You look at a currency such as the Philippine peso, another emerging market currency against the dollar, it's the same deal, even though it hasn't really appreciated that much this year. For someone who's still bearish in emerging market currencies against the dollar, this could be a good trade idea, shorting the Philippine peso against the U.S. dollar, because of the well-defined risk reward levels. You're essentially getting at today's market prices, to enter the trade. Again, and just let me be clear, I'm not insinuating further weakness, but it's a I'm just hinting of the possibility of a trade opening up if that's your thesis. And a currency like another currency like the U.S. dollar against the Colombian peso has deteriorated even further. This currency, if I'm not mistaken, is the currency has the valued the most since the beginning of the year, and it's devalued a whopping 78% since the beginning of the year. A lot of people like to isolate uh, different factors, and to describe what is happening to the local currency, and that's fine. Of course, you're going to see auto sales take a hit. Of course, airlines are going to have to reduce prices, and essentially take, on higher costs to keep up or book the same level of seats as they did just a few months ago or even a year ago, to keep up with the demand and trend, and so not, or to keep operating margins at a consistently higher level. But um, the net effect is that the income effect overrides the substitution effect whenever a currency depreciates by so much. And in the case of the Colombian peso, as such with the Brazilian real and other emerging market currencies, the fact that the net effect, either way you slice it, and again the big effect is the fact that people in this country are 78% poorer today than they were 2 years ago. I mean, that's the overall effect. Yes, people are obviously going to spend less. They're going to be less willing to take trips abroad, or less able, right? Not just being willing to, but just less able. And there's other effects, but that's really the net effect that most people I talk to, and I again read and listen to on TV, are completely either oblivious to it, or just it hasn't really hit homes. Hasn't hit home yet because it's been such a recent event. But this is not an encouraging sign, not just for the Colombia's economy as a whole, but for, and not just for the emerging market, economies, but for the entire world. It shows you how little depth there are to some of these markets, how liquidity is still at the forefront and the main concern of most investors, and how illiquidity is essentially driving um, people to invest in the only means or the only market, right, or the only investment that actually has some depth and liquidity to it, and that's the U.S. dollar. So more than anything, more than China potentially entering a recession, people are not flirting with that idea. More than the U.S. probably flatlining for for as long as the eye can see. More than Europe battling a deflationary spiral. All those are of course contributing factors that one should recognize. But the overriding theme behind it all is the fact that there is no liquidity in the system. Period. The liquidity, temporary liquidity that was there, and that was given in a way, or that was promoted by central banking authorities through their policies, which were needed. I'm not saying they were not needed. At the time they were needed, are simply they're no longer working. They're no longer effective policies, and it shows. So imagine what a quarter of a percent, half a percent, or even a meaningful 1 to 2% uh, rate increase in something like the Fed funds rate would do to the financial markets. What we have today is simple: an economic malaise around the world, and a financial market that has grown too accustomed for too long to a world of zero risk, where essentially the cost of borrowing and funding is 0%, and in the event that those costs increase, they're willing to throw a hissy fit, right, a tantrum of sorts, and basically force global central banking authorities to keep the current level of interest, or the current level of interest or current level of cost fixed at a very low rate, so that they can essentially enter trades or investments, not just in the stock market but elsewhere, at an efficiently lower cost. That's not how the system or the capital markets were, again, made to believe, or that's not how a capital market is set to function. That's, I guess, what I'm trying to say. But I mean, that's the only way, and I've said it a million times, is for the entire system to reset. And by reset, it means legislative, not just politically, but in not only economically, but also social reform needs to be adopted worldwide. I mean, the laws of old have have most of them will have to get repealed, and you will have to see a complete change in dynamics of how capital markets work, and how society functions. I mean, we're entering seriously. I mean, most people say this is crazy, but this is exactly what needs to be done. Yet there's very little need or urge to do it. So until that happens, I fear that we're going to get more volatility in the markets, more of a need by everyone to buy dollars, even if it doesn't make economic sense or the best investment sense. They're going to want to buy dollars because it's the only thing that they can put their money in, and essentially know that it's going to be there the day after tomorrow. Bonds is a running collapse. Equities is showing that it's cracks. Yes, it has a potential, but again, you have to be very careful for the exact reason I mentioned before of illiquidity. So I probably went over my allotted time. Made this video probably longer than I should. I apologize, but it's some thoughts I had in mind, and hopefully they're taken to heart. The last point I want to make is I know I haven't really posted a new blog post recently. I apologize. I've been busy with other matters that I need my attention. Um, my focus right now, my main priority is to get some of this stuff done and help the customers I serve, um, you know, with any questions they have, and essentially put them in a better financial position that when they join. So those are my two main priorities. I have to get it done. And until then, uh, I'll be restricted to just posting weekly videos. I may share a blog post here or there every now and then. When I do, I'll share. I'll make sure to mention it. And other than that, I want to thank you for taking the time to watch the video. And I'll talk to you next week.